leaves us with one remaining speaker for the day. We have saved the least interesting for last. And so I was asked to do a brief presentation and talk about the general economic environment and where we are. And what I really wanted to focus on today was the employment forecast and the information with that the Center for Economic Development and Business Research had released just a couple of weeks ago. But in sort of broad context here, one of the things that we ask a lot is, are we in a place where, it's the longest economic expansion that we've had since World War II, and are we due for a recession? And so you can see on this chart, this is real gross domestic product growth, but the blue shaded areas are the recessions that we've seen essentially since World War II. And as you can see from this, on the far right-hand side, we are in the longest expansion period without recession we haven't had since World War II. And so there are some analysts who sort of seem to imply that we must be due for a recession. It must be imminent. And I want to dispel that myth today. There is no timeline on which an economic expansion must somehow end. Recessions are the result of a misallocation of capital. That capital could be physical capital, like plant and equipment. We've built the wrong equipment, demand has changed, and now we need to adjust those resources and move them to something else. And it's those transitions that are costly that are actual causes of the recessions that we have. So physical capital, human capital, people are trained with the wrong skills, and we need to change those skill sets and move them into a different set of skills to be able to meet the needs that we have going forward. It could be financial capital, like we had in the last recession, where we had a misallocation of resources in terms of financial capital. In order to know when the next recession is going to come, we really need to identify where are the imbalances and the misallocations of capital. And most of the time, we don't see them coming. We really don't have a great way of predicting where they will happen next. And so, again, the point that I wanted to make here is just that we do not have some timeline at which we must be due. A recession is imminent, and therefore it has to happen. The expansion could continue indefinitely, and at the same time, we know a recession will occur eventually. That's just the way the world works. Of course, because we've been in this broad expansion, our unemployment rate has been extremely low, both nationwide and in the Wichita area. And I wanted to give some historic context of that. So this is, again, going back to the 1950s. The national unemployment rate right now is the lowest rate that we've seen since the late 1960s. And the only time we saw it lower since World War II was in the early 1950s, right after the recovery and the things that happened at the beginning, the expansion that began following World War II. And so incredibly low unemployment rates that we're dealing with right now. At the same time, whereas nationwide we've seen some solid employment growth, Wichita, our employment has lagged behind. Now this is a little bit of a strange chart, and so I want to make sure that I explain it to you. What I've done is I've taken the employment numbers, the jobs that we had in Wichita and U.S. at the beginning of 2008, which is roughly the peak before we entered into the Great Recession. And every other number on this is the jobs numbers relative to that point in time. And so you can see that nationwide, total employment dropped down to a level of about 94, which means that we had job losses nationwide between 2008 and 2010 of about 6%. In Wichita, we had much worse employment declines. We dropped down to a level of about 92, 93, meaning that we had 7 or 8% loss of jobs during and following the Great Recession. Since then, the U.S. has had pretty solid employment growth, and the total jobs numbers are up to about 110, which means that the jobs nationwide are 10% higher than they were prior to the onset of the Great Recession. And the difficult part that we see here in Wichita is that we have not fully recovered. Our total employment numbers are lower today than they were back in 2008. And that's a kind of a strange dichotomy. We have extraordinarily low unemployment rate, and yet we don't have the solid job growth that we wish we had. And I would say that ultimately that really is a reflection of our lack of population growth in the Wichita metro area. The businesses that are here, for the most part, are in expansion mode. They would like to hire, they would like to add new employees, but they have extreme difficulty in finding the skilled workforce that match the jobs that they need. And whenever Andy is sitting in the audience and he's nodding when I'm talking, I know that I'm on the right path here, because he is where the rubber meets the road on a lot of these issues there. So this is the employment forecast that the Center for Economic Development and Business Research released earlier this month for the city of Wichita. Actually, this year is turning out to be very strong employment growth for Wichita. 1.3% is much stronger than we've seen in many years. The forecast is for that growth to slow down just slightly, but still about 0.5% employment growth, and that's about par for the course of where we've been. We'd like to see stronger employment growth. Demand is there among businesses, but we just don't have the population migration to support that. I thought from a standpoint of this audience, it might be interesting to see breaking down employment based on different property types. And so what I've done here is I've taken the different sectors and said which sectors, in this case industrial employment, which sectors of the economy are most likely to demand industrial space. With the idea being that when employment increases in a particular segment of the real estate market, that ought to reflect stronger demand for space in that segment of the market. And so this is industrial employment, which would be manufacturing, transportation, warehousing, those types of jobs. And this is the year-over-year percentage change in employment in those segments of the economy, both for Wichita and for the state of Kansas. And Wichita is the red line on these graphs. And so one of the things that I think is really encouraging here is that over the last year or so, we've seen some of the strongest employment growth in the industrial sector that we have seen in the last decade or so. So it's been really very solid, and that's a very positive trend for us and should bode well for industrial demand going forward. What about the office market? Once again, we've seen some pretty solid office employment growth here over the last couple of years, much stronger than we've seen. You'll notice these numbers do bounce around a lot, so don't get too concerned about that most recent number that's down. Instead, focus on the underlying trends, and that's been a pretty solid growth rate here. Again, the best we've had since prior to the onset of the Great Recession. The retail has been a different story. Retail employment growth we've actually lost jobs in the retail sector in Wichita over the last few years. If I said you shouldn't get too worked up over the most recent numbers, they're subject to revisions, and so that downtick in office employment in the last slide, I said don't worry too much about that. I guess I'd also say don't get too excited about that uptick on the retail number here. It's potentially a change in trend, and we're seeing some positive growth there, but that has yet to be seen whether that's going to continue over multiple months to really say that that's a positive growth. The last thing that I wanted to touch on in terms of an economic overview here has to do with interest rates and what's happening with the yield curve. And if this is one area where I think you have a number of analysts saying maybe we're in due for a recession and that there's some portent of an upcoming recession where there's at least some historical data that supports this kind of view. I don't necessarily agree with it, but I would have been remiss if I don't address it. And so what I have on here is the 1-year Treasury rate and the 10-year Treasury rate, what the U.S. federal government pays to borrow money. And we had been seeing a very strong uptick in one-year Treasury rates going there for about 4 years. And then over the last year or so, we've seen a sharp decline in both short-term interest rates and longer-term interest rates. And of course, we particularly care about that 10-year Treasury in real estate markets because it's a benchmark against which a lot of our lending rates are based. And so essentially what we've seen, this next chart is a formal representation of the yield curve, and you'll hear about that. What you see on the horizontal axis here is the different terms of U.S. government borrowing. So the 3-month Treasury rate, the 1-year Treasury rate, the 5-year, and the 10-year Treasury rate. And each line is 1 point in time. And so if you start with the green line, that was about a year ago. The yield curve was what we would consider a normal upward sloping yield curve. The 5-year Treasury was higher than the 3-month Treasury, and the 10-year Treasury was a little bit higher than that. This was a very standard economic, this is a sign of growth and solid economy, what we would expect from the yield curve. About 6 months ago, the yield curve started to flatten out. That's the April 12th number there, where you see that the 3-month rate was about the same as the 10-year rate. And now we're in a situation where we do have an inverted yield curve, where the short-term rate is lower than the long-term rate. And historically, a lot of analysts have said, well, that's a situation that's predictive of a recession. And I'm not as convinced of that statement. It certainly is the case that historically speaking, often when the yield curve inverts, a recession follows. But what an inverted yield curve really means is that investors are expecting short-term interest rates to fall in the future. You can't have high long-term interest rates high short-term interest rates and relatively lower long-term interest rates. It just doesn't make sense. Why would you invest in a 10-year Treasury if you could invest in a 1-year Treasury and just keep rolling it over and get a higher yield? You have less risk because you haven't tied up your money. And so if the 10-year Treasury is lower than the 1-year Treasury or the 3-month Treasury, it must mean that investors are expecting that those short-term interest rates are going to decline in the future. Now, there are lots of reasons why those short-term interest rates might decline, one of which is there's a recession and the Federal Reserve is going to aggressively try and field off the impact of that recession by lowering short-term interest rates. But we're in a very strange world right now. We've been in a world where we have had negative real interest rates at the short-term side of things. And so this picture right here is the blue line is the 1-year Treasury rate, so what the federal government pays to borrow money over 1 year. And the red line is inflation expectations, a consumer survey of what people think the inflation rate will be over the coming year. Implicitly, then, we can subtract that from the 1-year Treasury rate to say, what is the real or inflation-adjusted rate of return that investors are expecting? How much do they think they can buy with their money a year from now when they lend the money to the U.S. Treasury? And the answer is they think they're going to be able to buy less stuff a year from now than they can today with the money they get back, because the real rate of return that they're getting is a negative rate of return. Now, over the last few years, you'll notice that green line was slowly approaching zero again, which is like, we normally think real interest rates need to be positive. It's just a normal economy. And over the last few months, we've seen a situation where those real interest rates have ticked back negative again. And the reason that I'm emphasizing this is that I think that over the last decade or so, we have been in a very abnormal financial world. We really have never recovered completely in the financial system from the impact of the financial crisis. And so, based on that, some of the past relationships and corollaries that we've seen won't necessarily hold true going forward in the future. Certainly, we do think that short-term interest rates are going to continue to go down. That's been the indication that the Federal Reserve suggests. It's what the financial markets are expecting with the inverted yield curve. But it doesn't necessarily portend a recession in the imminent future. Now, as an economic forecaster, the one thing we're really good at is being wrong. And so, your guess is as good as mine when the next recession will occur. But I wouldn't necessarily use this indicator as saying, yes, we're due for a recession next year. So with that, I'll go back to kind of the two key points that I think are important to take away from the Wichita market, which is number one, we're at an incredibly low unemployment rate. It's historically low levels. And we're unemployment growth, our job growth has been relatively solid this year. We'd love for it to be stronger, but the big challenge is we just don't have the workers that we need. And so if we can just convince more people that Wichita is the most awesome place to live in the world, then I think our economic prospects here in Wichita are actually fairly solid. With that, I am done. I'm happy to answer a few questions, but I think we're right at the time that we want it to be. And so if there are no questions, any questions? I have a question over here. Yes, Brad.
Stan, obviously you know what you're talking about.
that is a bold assumption you're making.
So with that, what is your personal best guess of when the next recession will occur?
I'm actually going to pass on that one, and the reason is no. I think it's foolhardy to try and predict anything economically over more than about 6 months to a year in advance. And so my best guess is we do not have a recession in tap for 2020. Okay, that's my best guess. I really believe that very strongly. I'll be very surprised to see that, but trying to forecast and say, oh, it's going to happen in 2022. That's just ridiculous to try and do that. Now, I thought I saw Andy over here first, and then I'll come back to you. So Andy.
Interest rates, one more tick down probably this year. Next year, election year, probably none, from what I'm gathering. Do you agree that they will not do anything next year for a number of reasons, and what effect will that have?
When I worked at the Fed prior to coming here, I was very fortunate to get to sit in on our briefings for the president, and when they would go and vote he would go and vote on the open market committee. And we always went through discussions about, how much do we need to take actions as the Fed based on what markets think. And at the end of the day, we always came back to, we can't worry about what they think. We need to do what we think is right for the economy, and the markets will figure out what we're trying to do with that. And I think that is still very much the mindset that they have broadly across the Federal Reserve System. And so, I don't think that there's any way to predict what they'll end up doing next year. And quite frankly, political and what's happening in the election cycle never once played a whit of difference in terms of what the Federal Reserve did. And so that would be my prediction, is that what will they do next year? It will be based on what they think is best at that time next year and have nothing to do with the election itself. So, Gary.
Yeah, I guess I'm of the opinion that the prime rate is still ridiculously high in relationship to treasuries.
Well, why don't you make loans? So people here would love to be getting lower interest rates. So go ahead, you can lower your rate if you want to, interest.
But it doesn't make a whole lot of sense. The treasuries are where they're at, primes are where it's at, and then we got the LIBOR deal going away.
Right. So the question related to how does it make sense with where we have with the prime rate relative to the 10-year treasury, and we're seeing essentially a widening of the spread between the 10-year treasury and other rates that often are benchmarked across that. That's true with 30-year mortgage rates and other interest rates as well. I think it's actually because what's driving the 10-year treasury down right now doesn't have anything to do with domestic economic conditions. What's driving it down is the international demand for finding yield anywhere. And if you've got to be a player in the financial system, there's a limited type number of investments that you can do. A international, multinational bank cannot go and invest in commercial real estate in Singapore, right? And there's limits to what they're able to do in that. And if you've got to be in the financial system, you've got to be in US dollars or euros or in something else. And so you're buying US treasuries, and that lack of yield that you have, you've got negative nominal interest rates in some European countries. And so that's really creating a disconnect. And that's another reason why I think that this inverted yield curve really is not some indication that we're due for a recession. It's really due to these abnormal situations that we have in the financial system.
It's more of a global market.
It's a global market that we're dealing with. Yeah. Gary, you had a question.
Well, that was going to be my question, is what, you're seeing countries now, international countries, putting a lot of money into sovereign debt funds at negative numbers.
Mm-hmm.
And that's because I think they're all trying to chase 10-year treasuries and all those and buy those, and they're just not, there's so much demand for that.
Yeah, there's just so much cash out there looking for yield. And some of it can go and look for yield in other types of investments, but there's a lot of it that has to stay in the financial system. And if it's got to be in the financial system, we used to say nominal interest rates can't go negative, right? That was kind of a truism that we would teach. And a lot of you would have heard me say this in your finance class that you had with me. But the fact is, negative interest rates happen. Why can't interest rates be negative? Because you can always pull your money out of the bank and put it under your mattress. There's no reason for me to keep my savings in Intrust Bank if they're going to offer me negative interest rates. I can just take it out and put it under my mattress and hold it as cash, unless I've got to be in the financial system and in the payment system. And that's what you have in those major international money center type transactions that you have. They got to stay in the financial system. Yeah.
But we would love to see our Wichita banks try it.
Yeah, you are welcome to. You're welcome. No, not only on the lending rates, not the deposit rates.
I'll take your deposits, we'll try it this afternoon.
That's
So,
under my mattress.
any other questions here today? Well, thank you very much. I've enjoyed being here today. I've enjoyed all of the speakers. I do want to give one last minute thanks to all of the Platinum sponsors that make these events possible. And so thank you very much. We'll see you at our next event.